All right, to continue our discussion of international portfolio investment, we have so this is a representation of where various countries sit on the return risk spectrum, right? So in Japan, you have moderate risk and very, very low returns on average historically. Um, whereas in the Netherlands, you have about the same amount of risk and quite a bit more returns. And so then, you would say, well, why would I invest in Japan then when things are clearly better in the Netherlands? But that's not actually how this works. So, in particular, if you have low correlation, it can be valuable to include an asset like Japanese equities because it reduces risk by more than it reduces the associated returns. And so, the this this line here represents all the possible combinations of a risk-free asset and the optimal Sharpe ratio portfolio. So you can, for example, if I was here, this would be, correspond to roughly half invested in the risk-free rate and half invested in the optimal portfolio. And up here, this would be borrowing, so if I had, a 400,000 investment, I would borrow 200,000 and invest 600,000 in the optimal portfolio. So up here, I'm using loans to increase my returns and risk. Down here, I'm investing in a risk-free asset. And so this optimal portfolio is going to compose the efficient set. And you can see in terms of risk-return space, this is the happy place up here, right, where we have really excellent returns and very low risk. We're never going to get there. But we have a spectrum of options along this line, consistent with buying the smartest portfolio and then utilizing the risk-free rate. And so a U.S. investor investing strictly in the U.S. can lower their risk and increase their returns by investing internationally, right? They could also strictly increase returns by investing here and then borrowing a little bit of money and investing more, right? So a small bit of leverage would just freeze risk in the U.S. and increase returns. Or you could freeze returns and do quite a bit less risk by optimally investing and just putting a little bit of money in the safe asset. But this is, compared to China, right? There's a huge gain to international investment, right? Either in returns or risk relative to a fully domestic Chinese portfolio or Japanese portfolio. So this argument is really important. This is where an argument like this is how we get to utilizing beta in the first place for estimating expected returns for stocks. So in general, when we think about measuring the performance of a diversified international portfolio relative to the domestic portfolio, we can do it a couple different ways. We can look at the increase in the Sharpe ratio, which is probably the cleanest way, but that's a little bit harder to interpret. But we can increase the we can increase the return while keeping risk constant, right? Or we can, obviously, we could decrease risk while keeping returns constant. But this demonstrates, right, the extra return, and then right. So if we think about, right, so let's look at one of the CN was Canada, not China, excuse me. So if we look at Canada, right, if we just invest in the domestic portfolio, we have an average monthly return of a little under 1% and a monthly standard deviation of about 5%. And if we go international, or our return increases to 1.13% and our standard deviation decreases by almost 2%. So that's going to be a big gain in the Sharpe ratio, right? Almost doubling the Sharpe ratio, and a huge improvement in the returns, right? So international relative to domestic Canadian is a huge improvement, right? So where are the biggest improvements? So that would be the biggest Sharpe ratio. So Hong Kong, very large improvement. United States, small but significant, right? But in general, on average, you get an improvement in Sharpe ratio of at least 0.5 and or 0.05, 0.05, and when Sharpe ratios tend to be 0.1, that's a 50% increase in the Sharpe ratio, and or right, or more, right? So that's this, right? So in Japan, the Sharpe ratio increases by 140%. So that's a giant gain from investing internationally. What you'll see is interesting then, because if you we'll look at what percentage of domestic investors in a set of countries invest internationally. So one important factor to investing internationally is that you have exchange rate risk as well as the price risk of the securities you're investing in. And so as a U.S. investor, investing in a foreign market subjects you to the risk of that security and the foreign exchange risk. Now, those things could be negatively correlated. They could be positively correlated, but they do both exist. So that's why we have. So basically, 1 plus the security returns times 1 plus the exchange rate return minus 1 is the overall return. And so we have this cross product term that's going to hang out. Now, typically this will be very small, right? If you think about returns, if the return is 10% and the expected exchange rate change is 10%, which is both very large, right? This term would be 1%. So this will tend to be very small, but yeah, it's composed of those two things plus this little extra. And so if we think about the overall effect on risk, we need to do, right? So the variance of the combined of the overall return will be the variance of the security return plus the variance of the exchange rate plus 2 times the covariance. That's, it actually comes from a 2x2 matrix and you have 2 diagonal terms. So this is just the same term twice. That's why there's 2 of them. And then this extra term from this RE at the end. So overall, the risk is composed of price return, exchange rate return, the covariance of those, and then that little extra piece. And so, so we'll look at some data on that in a second. Now, the international bond investments follow the same kind of structure or content. There's information, so international bonds are investable just like equities are, and we have kind of the same situation. A difference would be that the exchange rate risk is the same between the two, but bonds are quite a bit safer, which means exchange rate risk is much more significant for international bond investment than international stock investment. And that makes international bond diversification more challenging to be effective, right? Because the whole point of going international generally is to get diversification. Bonds benefit less from diversification because they're less risky at the outset, and it doesn't mitigate any of the exchange rate concerns. So it still can make sense to invest internationally in the bond market, but larger domestic holdings in bonds relative than equities would make sense. So here is an overall decomposition of international security returns from the perspective of a U.S. investor, right? So from the perspective of a U.S. investor, Germany is the riskiest stock market to invest in, right? More than double the risk of the United States. And where is this coming from? So in the case of Germany, right, we can see that almost all of the risk to investing in German equities comes from the underlying asset risk, right? There's moderate exchange rate risk, a small negative correlation between the asset returns and the exchange returns, and then a negative contribution for that last term. So in Germany, this high number is driven primarily by the risk of German securities. Whereas in Australia, we're 10% less risky, but we're 20% or 20% less security risky, but there's quite a bit more correlation, right? So that's the difference here. There's quite a bit more correlation between exchange rate risk and securities risk in Australia than it is in Germany. If you're not familiar with the Australian stock market, a large chunk of the Australian economy relative to other places, is in mining, which is commodities, which tends to be globally integrated, right? Commodities markets are very global relative to some other things like services. And so, that means that, that makes the Australian market behave differently. And so a spike in commodities prices might cause an increase in the Australian stock market and a decrease in the German stock market, right? Because the German firms are in the position of buying commodities while the Australian firms are in the position of selling commodities. So that's, an explanation of how, one way in which maybe these could, be different. And then in particular, Japan, right? They're very resource poor. And so they're probably subject to that even more so than Germany is. So, they're from the perspective of an American domestic investor, there's quite a bit of difference between the risk levels of the various countries, factoring in exchange rate risk. In general, though, that final term, right, that last term has very little contribution, with the exception of Japan. Japan is a little bit bigger, but right in the case of Japan, right, the negative covariance cancels out basically all of the risk associated with the exchange rate, right? So the overall risk, so for an American investor in Japan, the risk an American investor in Japan faces is pretty much identical to that of a domestic Japanese investor in Japanese securities, because of the hedge benefit of the covariance of the stock returns with the exchange rate. So to diversify, right, how do we make this work, right? So practically, how does one go about doing this? So there are some vehicles that make it effective to invest internationally, because direct investment in individual, right? If I wake up one morning and think, hey, I should buy this one specific Italian firm, well, that's not generally going to be easy, right? I have I might need to have an Italian bank account. I might need to have a broker in Italy, and they might not even have anything other than an over-the-counter stock system. So, depending on the locale and how it all works, it can be very, very difficult to do a direct investment, and also not really necessary since we're trying to get a broad investment anyway. So that means often international investment is done through funds or third parties of various types. So we'll talk through some of those. So one way to invest internationally is through an open-ended mutual fund. There's lots of global mutual fund options. So I'd mentioned before that I have international equities in my retirement accounts, and that is through an international specific mutual fund. So the idea is the mutual fund does all the work, right? I mean, if you're big enough mutual fund, you can afford to have boots on the ground in some countries to actually get these transactions done, right? So mutual funds, that global mutual funds can invest directly in international equities, and then you invest in your little tiny slice of the bigger mutual fund, and then they charge a fee for that. Right, a cheap mutual fund will charge 0.25% per year. A more expensive one will be 2%. International funds tend to be on the more expensive side. It depends if they're actively or passively managed, but regardless, even a passively managed international fund will be more expensive than a domestic fund typically. So it's great. You can get in and get your money out easily, very, very low transactions costs. It gets around a lot of, you're not going around the legal barriers. It's just that someone else is doing the legal work and then spreading that legal work over lots of customers. So it makes it more cost effective for all the participants. And if it's an active fund, you'll get the benefit of professional money managers. A country fund is a fund that just invest specifically in one country. So the idea is they're experts in that one particular country. They accrue investments in that country, and then by buying in that fund, you get exposure to that country. It's convenient. It's good as building blocks. It allows for having country theses, right? So, for example, my global fund that I'm invested in, if I'm really not bullish on Brazil, I have no control over that individual allocation. That's not a thing. So the next one is so continuing the country funds. A lot of country funds have closed-end status. This makes sense because you would raise a bunch of money, and then invest that money in the fund, and then you wouldn't have to touch it. It could be a buy and hold strategy, and then those shares trade, and either at a premium or a discount. Another option is ETF. So exchange traded fund is a vehicle that tracks a specific index, but it could be a country index, right? And they trade like shares, so you would buy and sell them on your discount broker of choice, or your Scottrade or E-Trade or Robinhood, whatever. And so that's that's like a closed-end mutual fund, except for exchange traded funds can increase or decrease in size as demand comes and goes. So they're tax efficient, liquid, transparent. They trade like stocks. So they trade less frequently, so that can be good for taxes. So it generates less taxable gains. So ETFs are a good option in the list. Depository receipts are like buying individual shares, but rather than buying the share, you're buying an American deposit account that has a share deposited in it. So it's an all-American transaction. It makes it legally much more secure. And so basically, somebody at some point did all the work to do an international transaction, and then we just trade the deposit after that. Hedge funds are also an option. That's a private investment fund. So you're hiring a money manager to do all that work. They tend to have more dynamic, aggressive, unique trading strategies. They charge much higher fees, typically 1% to 2% of all the money, and then 20 to 25% of the gains on top of that. It's not, those kind of funds aren't accessible to unless you're an accredited investor, which, you can, there's some certification that allows you to do that, but outside of certification, you need, I think it's $1 million some odd of non-home assets or $300,000+ of income. So it's not really accessible to most people. It can be true. All right. So also we want to think about international diversification with respect to industry, style, and factor portfolios. Which kind of industries are of interest, right? I mentioned that Australia is heavily in mining, so you can think about, well, what if do I want an Australian mining index or factor, or think about trading British momentum, right? So size, book to market. That's how expensive the stock is relative to its earnings, and whether it's gained or lost recently. You can invest specifically in stocks in from a particular geography that have fallen over the last 6 months, and then they rebalance that portfolio as stocks stop or start falling. So that's style investing or factor investing. I think it can be a unique way to increase the variety in the portfolio. So yeah, that's it. Thanks for hanging out for international portfolio investment.